Trading or investing successfully isn't about finding the next big stock or timing the perfect entry. It's about mastering yourself. The market is a mirror. It reflects back your beliefs, your fears, your expectations, and your level of discipline. Most people step into the world of investing thinking it's about predictions, analysis, or following experts. But the truth is, profitability begins and ends with psychology. The portfolio you build is not just a collection of assets, it's a reflection of your mindset, your patience, and your ability to manage uncertainty without emotional interference. Every trader or investor starts with the same desire to make money. But few realize that what truly separates the consistently profitable from the inconsistent is not knowledge, but the ability to execute with consistency under pressure. When money is on the line, the emotional charge that accompanies every decision can distort perception. You might see opportunity where there is none, or danger where there is only temporary fluctuation. The market itself doesn't create fear, greed, or doubt. It merely exposes them. A profitable portfolio, therefore, isn't about what you own, but how you think about what you own. The first step toward profitability is to recognize that success in markets isn't random. It's structured around probabilities. Every trade or investment idea carries an uncertain outcome. No one can know with certainty what will happen next, and yet most people behave as if they should. They crave certainty, they chase reassurance, and they end up reacting emotionally to every movement. A professional understands that uncertainty is the only constant and structures their portfolio around this truth. By managing risk, defining position sizes, and accepting the randomness of short-term results, they create the mental space for long-term success. Consistency doesn't come from being right all the time. It comes from managing wrong decisions effectively. You don't need to win every trade or every investment to build wealth. You just need to control losses and let profits grow naturally. This requires a shift from trying to avoid losses to understanding that they are a normal part of the process. Most investors fail not because their ideas are bad, but because they refuse to accept small losses. They turn temporary setbacks into emotional spirals and from there into major drawdowns. A profitable portfolio thrives on discipline, not prediction. What makes this game fascinating is that you are always playing against your own perception. The market doesn't care about your opinion, your hopes, or your fears. It will do what it does, regardless of how you feel about it. The only thing you can truly control is your response, your ability to follow your plan, to act on probabilities rather than impulses, and to view every outcome as feedback rather than judgment. The portfolio you hold is the story of your decisions, written in numbers, shaped by emotion, and defined by your willingness to stay objective when everyone else reacts. Embracing uncertainty is the single most important mindset shift you can make if you want to achieve consistency and profitability in the markets. Most people enter trading or investing looking for certainty. They want to know what's going to happen next, which direction a stock will move, or when a trend will reverse. The need for certainty is a deeply human impulse. It provides comfort, control, and emotional security. But in the market, certainty does not exist. Every piece of data, every chart pattern, every expert opinion can only ever represent probability, not guarantee. The moment you try to impose certainty on something inherently uncertain, you create psychological tension. You start to interpret normal market movement as personal validation or personal attack. When prices move against you, it feels like the market is wrong or unfair. When they move in your favor, you feel invincible. Both actions distort your ability to stay objective. To embrace uncertainty is to fully accept that you will never know what will happen next. You may have an edge, you may have data on your side, but no outcome is ever guaranteed. This understanding liberates you from the illusion of control. It allows you to operate without emotional interference. Most people think that embracing uncertainty means giving up control. But in reality, it's the opposite. When you stop trying to predict or control the outcome, you gain control over yourself. You become free to act on your edge without hesitation or fear. You stop second-guessing your system every time the market does something unexpected. You understand that being wrong is part of the process, not a reflection of your intelligence or worth. Every consistently profitable trader or investor has made peace with randomness. They understand that markets are a complex system driven by millions of variables: economic data, geopolitical events, corporate actions, emotional reactions, and random shocks. No one can process or predict them all. Instead of resisting this chaos, professionals learn to flow with it. They develop systems that work over time, not because they predict each move correctly, but because they manage uncertainty effectively. They risk a small amount on each position, understanding that any single trade or investment could fail. They don't need to know what will happen next because they know how to respond to whatever does happen. The unprofitable majority, on the other hand, spends their time searching for something that doesn't exist: the perfect system, the foolproof indicator, the guaranteed signal. They move from strategy to strategy, convinced that consistency lies in finding certainty. What they fail to see is that their inconsistency comes not from their system, but from their psychology. They can't tolerate the emotional discomfort of uncertainty. Every loss feels like a threat, every drawdown like a mistake. They abandon their plans too soon, not because the market invalidated them, but because their emotions did. When you embrace uncertainty, your relationship with the market changes completely. You stop reacting to price movements as if they're personal messages. You stop feeling betrayed when the market moves against your position. You start to see each outcome as just one instance in a long series of probabilities. Winning and losing become neutral events. Both are information. The goal is not to avoid uncertainty, but to function effectively within it. Once you accept that the market will always be uncertain, you stop fighting it. You can think clearly, execute decisively, and manage risk without hesitation. Embracing uncertainty also means redefining what success looks like. Most traders and investors define success by outcome. If a trade makes money, they feel successful. If it loses, they feel like failures. This binary mindset is toxic because it ties emotional state to random short-term results. In reality, success lies in following your process regardless of outcome. A losing trade executed with discipline and consistency is a success because it reinforces the behaviors that lead to long-term profitability. A winning trade taken out of fear or impulse is a failure, even if it adds money to your account, because it reinforces emotional decision-making. Once you learn to measure success by process rather than outcome, uncertainty loses its emotional grip. You no longer need to know what will happen next. You only need to know that you will act correctly no matter what happens. There's another layer to embracing uncertainty. It forces you to confront your ego. The human ego hates uncertainty because it thrives on being right. When you build a thesis or take a position, your ego wants validation. It wants to be proven correct. When the market disagrees, your ego interprets it as an attack. You start defending your position not with logic, but with pride. You hold on to losing trades longer than you should, hoping the market will eventually come back and restore your sense of being right. This is where most major losses begin, not with bad analysis, but with the refusal to accept uncertainty and be wrong. True confidence in trading doesn't come from knowing, it comes from not needing to know. When you no longer need the market to prove you right, you can act with true freedom. You can cut losses without hesitation because you're not defending your ego. You can let profits run without fear because you're not trying to control the outcome. You're simply executing your plan trade after trade, allowing probabilities to play out. Each individual result loses its emotional charge and consistency becomes possible. Accepting uncertainty also enhances your ability to perceive the market objectively. When you stop expecting certainty, you begin to see what is actually there, not what you want to see. You stop forcing your opinions onto the chart. You become more attuned to subtle shifts in behavior, to changing momentum, to evolving trends. Your analysis becomes cleaner because your perception is no longer clouded by the need for reassurance. Ironically, the more comfortable you become with uncertainty, the more clearly you can read the market. You begin to see patterns of behavior that were invisible when you were emotionally attached to outcomes. In practical terms, embracing uncertainty means building systems that acknowledge randomness. It means defining your risk before every trade or investment and accepting it fully. It means setting stop losses not as emotional safety nets, but as structural boundaries of probability. It means understanding that even the best setups can fail, and that's not a problem, it's part of the distribution. When you operate this way, you no longer see uncertainty as a threat. You see it as the natural environment in which opportunity exists. Without uncertainty, there would be no potential for profit. This shift in mindset transforms not just your trading performance, but your experience of the market itself. You stop oscillating between hope and fear. You stop trying to force outcomes or chase certainty in the form of news, tips, or signals. You begin to act from a place of calm detachment. The market's randomness becomes an ally rather than an enemy. Every moment becomes an opportunity to execute well, to reinforce discipline, and to express trust in your process. This is the foundation of consistency, not control over outcomes, but control over yourself in the face of endless uncertainty. Focusing on risk management over prediction is the defining trait of every consistently profitable trader and investor. The desire to predict the market's next move is what traps most people in cycles of frustration, while the commitment to manage risk is what sets professionals apart. Prediction feels powerful. It gives the illusion of control, of being smarter than the market. But in reality, prediction is a psychological comfort mechanism. It allows people to believe they can know the unknowable. The market, however, does not reward certainty, it rewards adaptability. No matter how skilled you are in analysis, how advanced your indicators, or how thorough your research, every single position you take is a probability. The only variable you can truly control is how much you are willing to lose if you're wrong. That is the essence of risk management. The idea of prediction appeals to the ego. It creates the belief that if you just study harder, read more charts, or follow the right experts, you can somehow eliminate uncertainty. But this pursuit of perfect foresight leads to emotional dependency. Every time the market moves unexpectedly, you feel betrayed. You question your analysis, your method, and sometimes your competence. The emotional swings between confidence and despair become exhausting, and they sabotage consistency. Risk management, on the other hand, bypasses this psychological trap. When you manage risk first, you no longer need to be right on every trade. You only need to survive long enough for your edge to play out. You stop chasing perfect predictions and start focusing on protecting capital, which is the only thing that allows you to stay in the game long enough to profit. The truth is that most people approach trading and investing backwards. They start by asking, how much can I make? Instead of how much can I lose? They imagine potential profits, but rarely calculate potential damage. This mindset is rooted in greed and fantasy. It blinds them to the fact that all profitable systems, no matter how sophisticated, are built around risk control. Professionals understand that their job is not to predict outcomes, but to manage exposure. Every trade or investment is simply one roll of the dice in a series of probabilities. You can't control which roll wins, but you can control the size of your bet. That control is what keeps you solvent through losing streaks and allows you to capture the long-term payoff of your edge. To focus on risk management means accepting the reality that losses are inevitable. They are not signs of failure, they are operating expenses of the business. You don't judge a restaurant for buying ingredients it doesn't sell. It's part of the process. The same logic applies to trading. Each loss is the cost of opportunity, the price of staying in the game. When you define your risk in advance, deciding exactly how much you're willing to lose before you enter a trade, you take back psychological control. The market can do whatever it wants, but your loss is already predetermined. You've already accepted it emotionally. This detachment frees you from the fear of being wrong and allows you to execute with clarity and consistency. Risk management also reveals a deeper truth about human behavior in the market. Most people are not destroyed by bad trades, but by oversized trades. The error isn't in being wrong, it's in betting too much when wrong. Without defined risk, emotions take over. Greed leads to over-leveraging and fear leads to premature exits. Both behaviors come from a lack of structure. When you build a portfolio or take a trade without a clear risk framework, you are gambling with your emotions and control. You might win a few times, but the one loss that goes out of control can wipe out months or even years of progress. Professionals never let this happen because they define their risk parameters before they think about potential reward. They know survival is the prerequisite to success. The obsession with prediction is also tied to the need for validation. Many traders equate being right with being smart. They crave the emotional high of calling a market move perfectly. They want to feel superior, to feel like they have cracked the code. But this emotional attachment to being right is dangerous. It causes people to hold losing positions longer than they should, hoping the market will eventually prove them correct. It also causes them to take profits too early, afraid of losing what they've already gained. Both actions come from the same place: ego. Risk management neutralizes this problem by shifting the focus from being right to being profitable. You no longer care whether your prediction plays out perfectly. You care whether your capital is preserved and your system remains intact. When you focus on risk management, your entire relationship with the market changes. You no longer see losses as painful failures, but as statistical outcomes within a defined system. You begin to think like a casino rather than a gambler. A casino doesn't know which player will win or lose on any given hand. It doesn't need to. It operates with a small edge and strict control over payouts. Over time, that structure guarantees profitability. The casino's secret isn't prediction, it's probability management. A disciplined trader operates the same way. Each trade or investment is a small wager with an edge, but always within controlled parameters. Over hundreds of trades, the law of large numbers takes over and consistency emerges naturally. This mindset also removes emotional noise from decision making. When your primary goal is to manage risk, you stop overreacting to every piece of news, every market fluctuation, or every opinion you read. You stop trying to predict the unpredictable. You simply follow your system, place your stops, and let the probabilities unfold. This doesn't mean you don't analyze or plan. You still prepare, but you do so knowing that your analysis only defines the setup, not the outcome. The outcome is always uncertain, but your exposure is always known. That's where true confidence comes from, knowing that no single event can destroy you. Effective risk management also demands self-awareness. It forces you to confront your emotional thresholds. Everyone has a point at which fear or greed overrides logic. The purpose of defined risk is to keep you well below that emotional threshold. If you risk too much, your mind becomes fixated on the outcome. You can't think clearly when every tick of price movement feels personal. But when you risk an amount that's truly insignificant to you emotionally and financially, you gain psychological freedom. You can observe the market objectively, make decisions without bias, and follow your plan without hesitation. This freedom is what creates consistency, and consistency is what leads to profitability. There's a paradox here. The more you focus on controlling risk, the more opportunities you can take. By keeping losses small, you maintain the ability to keep trading, to keep learning, and to keep capitalizing on favorable probabilities. Those who chase predictions often miss opportunities because they hesitate, waiting for perfect certainty that never comes. Those who manage risk act decisively, knowing that even if they're wrong, the damage is minimal. Over time, their accumulated small losses are outweighed by larger, controlled gains. The key is repetition, executing small, the controlled decisions over and over again with emotional neutrality. Another critical component of risk management is diversification. Many traders misunderstand diversification as simply spreading money across different assets, but true diversification is about spreading risk exposure across uncorrelated opportunities. It's not about owning more positions. It's about ensuring that no single outcome can cripple you. Each position represents a small piece of your total capital, a calculated probability in a larger portfolio structure. When risk is balanced this way, the outcome of any single trade loses significance. This structure allows emotional detachment because your future doesn't depend on one position working out. It depends on your process working over time. Focusing on risk management over prediction requires humility. It requires admitting that no one knows what will happen next, not even the most skilled analyst or the most experienced investor. It means surrendering the illusion of control and instead mastering the only thing you can control, your exposure. The goal isn't to predict direction, but to survive volatility. It's about understanding that the market is a probabilistic environment where anything can happen, and your job is to make sure that whatever happens, you're still standing afterward. When you learn to think this way, the market stops being a source of fear or excitement and becomes a field of structured opportunity where the only real edge is disciplined risk control applied with consistency and emotional balance. Detaching emotionally from outcomes is one of the most difficult yet most transformative steps in becoming a consistently profitable trader or investor. Most people enter the market with the expectation that each trade, each decision, and each result carries deep personal meaning. They interpret winning as validation and losing as failure. This emotional entanglement with outcomes is the reason most can't sustain consistency. The market becomes an emotional battlefield where every fluctuation affects mood, confidence, and decision-making. Detachment, however, creates clarity. It separates performance from emotion and allows decisions to flow from logic, structure, and probability instead of fear or hope. Without emotional detachment, discipline is impossible, and without discipline, profitability cannot exist. The core problem is that humans are wired to avoid pain and seek pleasure. In the market, pain manifests as losses, missed opportunities, and uncertainty. Pleasure manifests as profits, validation, and being right. When you are emotionally attached to these experiences, your decisions stop being rational. A loss doesn't just represent a numerical reduction in your account, it becomes a personal wound, something that affects your sense of competence or worth. Similarly, a win doesn't just represent a good trade, it becomes proof of intelligence or superiority. Both responses create imbalance. You start chasing the feeling of being right and avoiding the feeling of being wrong, which leads to impulsive trades, overconfidence after wins, and paralysis after losses. Detachment removes that cycle by neutralizing emotional charge. A trade becomes just another expression of your edge, not a reflection of your value as a person. The market rewards neutrality. It rewards those who can execute their edge repeatedly without hesitation or bias. Emotional attachment introduces distortion into perception. You begin to see what you want to see instead of what's actually there. When you want a trade to work, you interpret neutral information as confirmation. When you fear loss, you interpret normal volatility as danger. Your analysis becomes a reflection of your emotional state rather than objective reality. Detachment corrects this distortion. It allows you to read the market as it is, not as you hope or fear it to be. When you detach, you no longer seek emotional reassurance from your trades. You no longer need the market to make you feel good about yourself. You simply follow your plan, manage your risk, and let probabilities play out. To detach emotionally from outcomes, you must first accept the nature of the market. It is a probabilistic environment. Every single trade or investment carries an uncertain result. No amount of analysis can change that. You can have the best setup, the cleanest, the strongest conviction, and still lose. You can also make a reckless, emotional trade and win. The outcome of a single event does not measure skill, it measures randomness. The only true measurement of skill is consistency over a large series of trades. Once you deeply understand this, your perspective changes. You stop judging yourself based on individual outcomes. You start evaluating based on behavior. Did you follow your rules, manage your risk, and act with discipline? When you measure success by process, not outcome, emotional detachment becomes natural. Many traders struggle with detachment because they confuse confidence with emotional investment. They believe that caring deeply about each outcome shows commitment or seriousness. In reality, it shows insecurity. True confidence comes from trusting your system, not obsessing over results. You don't need to feel emotionally attached to every trade to trade well. In fact, the opposite is true. Detachment doesn't mean apathy. It means emotional neutrality. You still care about performance, but you care in a structured, professional way. You analyze, you adjust, but you don't react emotionally. You treat trading as a business, not as a test of identity. One of the most damaging emotional traps is the need to be right. The ego equates being right with success and being wrong with failure. This belief leads to destructive behaviors, holding on to losing positions in denial, moving stops further away, or averaging down to protect pride. The longer the market moves against you, the stronger the emotional attachment becomes. You start arguing with price as if the market owes you agreement. This battle always ends the same way, with emotional exhaustion and financial damage. Detachment breaks this cycle by separating your self-worth from your trades. You're not your results. The market doesn't care about your beliefs, and it's not your job to make it agree with you. Your job is to align with what the market is doing, not what you think it should do. Another obstacle to detachment is the emotional aftershock of winning. Most people assume that losses are the only emotional challenge, but wins can be equally dangerous. After a big win, euphoria sets in. You feel invincible, convinced that you've finally figured it out. This emotional high leads to overconfidence, larger position sizes, and reckless trades. The mind forgets risk and becomes addicted to the feeling of winning. Soon after, when the inevitable loss comes, the crash is even harder. Detachment prevents this cycle by treating wins and losses as equal. Both are simply results of executing an edge in an uncertain environment. You neither celebrate nor mourn them. You analyze them, learn from them, and move forward. The practical path to emotional detachment begins with structure. You need clearly defined rules for entry, exit, and risk. When decisions are rule-based, they require less emotional input. You no longer have to decide in the heat of the moment whether to exit or hold. Your plan does that for you. The more structured your process, the less room there is for emotional interference. This structure builds trust in your system, and trust is what makes detachment possible. When you trust your rules, you stop trying to control outcomes. You know that over time, your system will take care of you, as long as you follow it consistently. Detachment also requires an understanding of probabilities on an emotional level, not just an intellectual one. Many traders say they understand probabilities, but their reactions prove otherwise. If you truly accepted randomness, a loss would not cause frustration, and a win would not cause excitement. It would just be another data point. To reach this level of acceptance, you must desensitize yourself to short-term outcomes. Trade smaller than you think you need to. Risk amounts that are truly insignificant to you. This reduces emotional charge and allows you to experience the market's ups and downs without inner turbulence. Over time, your nervous system adapts. You stop reacting, you start observing. Another powerful step toward detachment is journaling. Writing down your thoughts, emotions, and reactions after each trade creates awareness. You start to see patterns, times when emotion dictated your actions, when impatience replaced discipline, or when excitement led to recklessness. This awareness is critical. You cannot detach from what you are not conscious of. Once you see your emotional patterns clearly, you can begin to separate them from your trading behavior. You start to realize that emotions are just sensations passing through you, not signals that require action. The market doesn't care about your emotions, so why should your trading decisions be influenced by them? Detachment also comes from redefining your relationship with money. When you view money as survival, every fluctuation in your account triggers fear. But when you view money as a tool for execution, it loses its emotional weight. The goal is not to protect every dollar, but to manage risk so that no single loss matters. This mindset frees you from the paralysis that fear creates. You start to see money as part of the process, a resource that flows in and out as probabilities unfold. This detachment allows for calm decision-making and consistent execution, regardless of recent outcomes. Emotional detachment transforms the entire experience of trading. The market stops being a source of anxiety or excitement and becomes a neutral environment for probability expression. You no longer chase emotional highs or run from emotional lows. You exist in a balanced state where you can observe, decide, and act without interference. This state of neutrality is what allows true consistency. When you are emotionally attached, every trade feels like a test of worth. When you are detached, every trade is just one more step in the continuous flow of your process. In that state, you can execute with precision, manage risk effortlessly, and maintain calm in the face of chaos. The market will always fluctuate, but your internal state remains steady, unaffected by outcomes, guided only by discipline and understanding of probability. Accepting losses as essential data, not failure, is one of the most profound mindset transformations any trader or investor can make. The majority of people entering the markets do so with an unconscious aversion to loss. From an early age, society teaches us that losing is bad, that it means we did something wrong, that it reflects our lack of skill or intelligence. This conditioning carries into trading trading, where every loss feels personal, emotional, and deeply unsettling. Yet, in the reality of the market, losses are not evidence of failure. They are the raw material of growth, the feedback loop that shapes understanding, discipline, and long-term profitability. Every professional who has achieved consistency has gone through the process of reprogramming how they perceive loss, shifting from avoidance to acceptance, from judgment to curiosity. In trading, losses are inevitable. They are part of the statistical structure of the game. Every edge, no matter how strong, has a distribution of outcomes, some wins, some losses, all governed by probability. The problem arises when traders interpret a single losing trade as an attack on their identity or competence. This emotional reaction leads to destructive behavior. They double down to make the money back, quickly abandon their system, or freeze in hesitation when the next opportunity appears. Instead of seeing the loss as a neutral event within a probabilistic framework, they see it as failure, and failure is something the ego cannot tolerate. By accepting losses as data, you remove this emotional charge. Each loss becomes information, a neutral signal that tells you something about your system, your execution, or your mindset. The market provides constant feedback, and losses are simply part of that feedback. When you take a loss, it's an opportunity to observe whether the setup aligned with your plan, whether your risk management worked as intended, or whether your emotions interfered. It's a diagnostic moment, not a judgment. Professionals understand that without losses, they would never refine their edge. The loss shows them where friction exists between theory and execution. It shows where emotional bias still influences decision making. By studying losses, you learn how to adapt, improve, and strengthen your process. Every loss contains data. Every data point refines your understanding of probability. Accepting losses also means detaching from the illusion of control. You cannot control outcomes, no matter how carefully you analyze or how certain you feel. The need to control leads directly to resistance, and resistance to loss creates psychological tension. You start expecting the market to behave in a way that suits your desires. When it doesn't, frustration or some emotional volatility is what drives most traders into inconsistency. The professionals, by contrast, operate with complete acceptance of uncertainty. They know that losses are the cost of participation, not punishment. Each one is expected, planned for, and integrated into their system. When you accept losses as part of the process, the anxiety around them disappears. You no longer see them as mistakes, you see them as proof that your risk controls are working. The ego, however, resists this level of acceptance. It wants to win, to be right, to feel in control. A loss threatens that self-image, triggering defensive reactions. The ego tries to rewrite the narrative. It blames the market, bad luck, or manipulation. This refusal to take responsibility for the loss prevents learning. When you see the loss as data, you dissolve this ego barrier. You stop needing to protect your identity and start analyzing with honesty. The loss becomes a mirror reflecting your behavior, not your worth. You can ask objective questions. Did I follow my rules? Was the setup valid? Was my size appropriate? Did emotion influence my decision? These questions turn losses into valuable feedback loops that accelerate growth. Another important aspect of accepting losses is understanding the difference between a good loss and a bad loss. A good loss is one that occurs while following your plan and managing risk properly. A bad loss is one that comes from breaking your rules, ignoring stops, or trading impulsively. Both result in losing money, but their meanings are entirely different. A good loss reinforces discipline and demonstrates that your system is functioning. It shows that your risk parameters are effective. A bad loss exposes emotional interference and lack of control. Both are valuable, but only if you interpret them correctly. When you stop labeling all losses as failure, you gain the freedom to analyze them constructively instead of defensively. Accepting losses as essential data also requires a deep understanding of probability. In a probabilistic environment, even a perfect setup can fail. If your edge has a 6% win rate, that means 40% of your trades will lose by design. These losses are not mistakes. They are mathematical expectations. Trying to eliminate them is like trying to play poker without losing a single hand. It's impossible. Professionals don't fear losing hands because they understand that the long-term edge depends on consistent execution, not short-term perfection. Once you fully internalize this, you stop taking losses personally. You know that every loss is part of the statistical path to long-term profitability. Most traders never reach this level because they treat trading as a test of prediction. They want to be right on every trade. They equate being right with making money and being wrong with losing it. But in reality, it's entirely possible to be right and still lose money if your timing or risk is off, and it's possible to be wrong and still make money if the market happens to move favorably. The key is not prediction, it's probability management. Losses are the cost of playing that probability game. The more you resist them, the more emotional and erratic your behavior becomes. The more you accept them, the calmer and more consistent you become. Embracing losses as data also requires emotional maturity. You must learn to experience disappointment without internalizing it. You can acknowledge frustration, but you don't act on it. This separation between emotion and action is the foundation of discipline. When you experience a loss, instead of reacting impulsively, you observe your response. What does the loss trigger? Anger, fear, denial, frustration. These reactions are signals pointing to unresolved beliefs about money, success, and control. When you confront these beliefs directly, you begin to neutralize them. The loss becomes a teacher showing you where your psychological boundaries still limit performance. Journaling is one of the most effective tools for turning losses into data. By documenting each trade, the reasoning behind it, and the emotional state during execution, you build a personal database of experience. Over time, patterns emerge. You start to see where errors repeat, where your emotional thresholds lie, and where your system performs best. The journal transforms losses from painful memories into structured information. It shifts your relationship with failure from emotional to analytical. Each entry becomes a piece of evidence that refines your behavior and strengthens your understanding of yourself as a trader. Accepting losses also builds resilience. The more you experience loss without emotion, emotional collapse, the stronger your psychological foundation becomes. You realize that no single trade defines you, no single event can destroy you. As long as you manage risk, this realization creates freedom. You stop fearing the next trade, the next market movement, the next outcome. You become fluid, adaptive, and grounded. The fear of losing evaporates because you no longer see loss as danger. It becomes part of the rhythm of the market, a natural oscillation between gain and drawdown that, when managed properly, leads to long-term growth. In this state of acceptance, you start to see that losses actually hold more value than wins. Wins confirm what you already know. Losses reveal what you still need to learn. Each loss highlights weaknesses in your psychology, your execution, or your system. Each one sharpens awareness and forces refinement. Over time, the very experiences you once feared become the foundation of your strength. You begin to welcome feedback in all forms, understanding that every negative outcome carries information. Instead of shrinking from it, you extract its meaning, adjust your process, and move forward with greater clarity. When you accept losses as essential data, you are no longer emotionally bound to short-term results. You stop oscillating between euphoria and despair. You find balance, discipline, and perspective. You learn to operate in alignment with the probabilistic nature of the market rather than in opposition to it. You become an observer of outcomes instead of a victim of them. Losses lose their emotional power, transforming from obstacles into instruments of mastery, guiding you deeper into self-awareness, consistency, and the true essence of profitable decision-making. Letting discipline define your edge, not your opinions, is the dividing line between those who succeed consistently in the markets and those who are trapped in cycles of hope, fear, and inconsistency. Opinions are easy to form. They are emotional, reactive, and often rooted in the need to be right. Discipline, however, is built through deliberate structure, repetition, and the willingness to act in accordance with a plan even when every part of you wants to do something else. The market doesn't reward intelligence or conviction, it rewards discipline. Every profitable trader or investor eventually learns that their true edge is not their system, their analysis, or their ability to predict. It's their ability to stay consistent in behavior, to execute their plan under pressure, and to maintain emotional balance when uncertainty rises. The human mind craves certainty and validation. It seeks to find patterns, to make sense of randomness, to believe that its opinions about the market of meaning. This is why so many traders spend endless hours analyzing charts, reading forecasts, and following experts. They want to feel certain to feel right. But the market does not respond to opinions, it responds to collective behavior, probabilities, and randomness. The moment you allow your personal opinions to override your rules, you hand control over to emotion. Discipline is the only structure strong enough to contain those emotions and keep you aligned with probability rather than perception. Without it, even the best strategy becomes unstable because your execution becomes inconsistent. Discipline is not about rigidity. It's about alignment. It means acting according to your system, regardless of temporary emotional impulses. The disciplined trader does not ask, what do I think the market will do? They ask, what does my plan tell me to do? This shift in focus removes the need for emotional validation. It grounds every action in predefined logic. Opinions fluctuate. Discipline endures. When you define your edge through discipline, you stop treating each trade as a separate event that requires unique judgment. Instead, you see each trade as one instance in a series, each one governed by the same principles of risk, entry, and exit. Over time, this repetition builds consistency, and consistency creates profitability. The danger of opinions is that they feed the ego. The ego wants to be right more than it wants to be profitable. It attaches identity to forecasts and becomes defensive when proven wrong. This attachment blinds perception and causes irrational behavior. You might see a setup that fits your plan but hesitate because your opinion about the market contradicts it. Or you might take a trade that breaks your rules simply because your conviction feels strong. In both cases, emotion replaces structure. The disciplined trader eliminates this dynamic by surrendering personal judgment to process. They understand that being right is irrelevant. Following their plan flawlessly is what matters. When you operate with that mindset, your results become a reflection of your behavior, not your opinions. Discipline is also the antidote to the randomness of outcomes. You cannot control whether a single trade will win or lose, but you can control how you act before, during, and after the trade. That control is what creates a statistical edge. A disciplined trader sizes their positions according to predefined risk, sets stops before entering, and never adjusts those stops emotionally. They don't move them further away to avoid a loss or closer to lock in small profits out of fear. They execute mechanically, trusting that the edge will play out over time. This approach might feel restrictive to the emotionally driven mind, but in reality, it's liberating. It removes decision fatigue and emotional turbulence. You no longer need to guess or justify. You just follow the process you built when you were calm and objective. Opinions often arise from emotional reactions to the market's movements. After a loss, your mind wants to protect you from pain, so it creates narratives the system isn't working, the market is manipulated, the conditions have changed. These stories justify deviation from the plan. After a win, the same mechanism creates overconfidence. You start believing your intuition is superior to your system. In both states, fear after losses and euphoria after wins are emotional extremes that erode discipline. The disciplined trader recognizes these emotional swings but doesn't act on them. They understand that emotions are temporary while structure is constant. They don't suppress emotion. They observe it without identification. That observation builds self-awareness, and self-awareness sustains discipline under stress. Discipline also protects you from the illusion of control. The desire to control the market is one of the most dangerous impulses in trading. It manifests in behaviors like revenge trading, overtrading, or constantly adjusting positions in reaction to short-term movements. This illusion comes from the ego's refusal to accept uncertainty. The disciplined trader, however, embraces uncertainty and accepts that control exists only over personal behavior. Discipline becomes the mechanism through which control is properly exercised, not over outcomes, but over execution. Each decision is made within a framework of probability and predefined risk. In that structure, freedom exists, the freedom to act without emotional resistance, to trust the process, and to remain calm regardless of results. Letting discipline define your edge also changes how you perceive time. The undisciplined trader lives in the short term, constantly evaluating performance based on the last trade or the last week. Their emotions rise and fall with every fluctuation. The disciplined trader thinks in series, not in moments. They know that one trade means nothing. Their focus is on the next 100 trades, the next 1,000 decisions. This long-term perspective is what allows consistency. It prevents overreaction to short-term randomness and builds emotional stability. Over time, this perspective compounds, not just financially, but psychologically. Each act of discipline reinforces confidence, and that confidence strengthens discipline further. Discipline is a form of self-trust. When you build rules and follow them regardless of outcome, you teach your mind that you can rely on yourself. This internal trust eliminates hesitation and fear. Most traders hesitate not because they lack skill, but because they don't trust themselves to follow through. They second-guess, overanalyze, and delay, all because their history is filled with emotional decisions and broken rules. The only way to rebuild that trust is through consistent discipline. Every time you follow your plan exactly, regardless of result, you reinforce self-integrity. Over time, this becomes your true edge, not the system itself, but your ability to execute it without deviation. There is a paradox in discipline that many fail to see. It feels restrictive at first, as if it limits creativity or flexibility. But in reality, it's the foundation of freedom. When your actions are guided by structure, you are no longer a prisoner of emotion. You no longer chase trades out of fear of missing out or hold on to losing positions out of denial. You move with clarity, acting only when conditions align with your rules. This freedom from internal chaos allows for creativity to emerge in the right places, refining your strategy, improving analysis, or adapting risk models. But those creative adjustments happen outside of trading hours, never in the heat of the moment. Another key aspect of letting discipline define your edge is consistency and preparation. The disciplined trader approaches each day the same way, reviewing setups, assessing risk, planning entries and exits before the market opens. This routine creates a psychological rhythm that anchors behavior. When the market becomes chaotic, the mind naturally wants to react impulsively, but routine stabilizes perception. You are grounded in process, not emotion. This consistency in preparation mirrors consistency in execution, and the combination creates a compounding effect. Over time, this repetition transforms discipline from an effort into a habit. You no longer have to force discipline, it becomes part of who you are. When opinions define your edge, every outcome feels like a personal test. When discipline defines your edge, every outcome is just data within a larger sequence. You don't celebrate wins as triumphs or mourn losses as defeats. You simply observe record and continue. This neutrality allows your edge to express itself fully because you are not interrupting it with emotional interference. Most traders lose not because their systems are flawed, because they cannot execute them consistently. The system loses its power the moment emotion overrides structure. Discipline preserves that power by ensuring consistent application across time regardless of circumstance. Ultimately, letting discipline define your edge is about surrendering the need for emotional validation and replacing it with trust and structure. It's about understanding that your opinions, no matter how convincing, are still just interpretations of uncertainty. The market doesn't respond to your thoughts or beliefs, it responds to collective behavior and probability. Discipline bridges the gap between uncertainty and control, between randomness and consistency. It becomes the invisible architecture that holds your trading psychology together, keeping you steady when volatility rises, when outcomes deviate, and when your emotions demand action. It is not about perfection or prediction, but about unwavering adherence to process, the quiet repetition of correct behavior in an environment built on chaos. Where the only true edge that endures is the discipline to act the same way every single time, regardless of what you think, feel, or believe.